Today, I'm going to show you that the metals boom has already begun. We're going to look at history, and I'm going to show you clear indicators that are going to demonstrate to you that the metals boom has clearly begun. Okay, the first thing we can look at are the increases in gold just to determine the periods. And then we can look at, we can compare the conditions in those prior periods to the conditions of today. So just to gather the periods, we have 1932, 1934 is when the gold price increased. FDR revalue gold went from 20 to 35. The next period we have started 1970s, peaked at around 1980. The next period we had started 2001, and there was a peak in 2011, 2012. So are we at the beginning phases of a metals boom? Has it already started? I'm going to give you the conclusive evidence that it has. So we now have the periods. Just know that every boom is similar to a boom in chemistry. A boom in chemistry, let's say if you did the middle grade or middle school experiment with the baking soda and the vinegar, where you made a volcano, you had a glass or let's say a tube of baking soda filled with baking soda. If you add vinegar, you get a explosion. Many elements form similar explosions by mixing ingredients. So with those explosions or with those booms, you need multiple components, you need multiple elements. In that case, you needed a glass, let's say, or a container. You needed baking soda and you needed vinegar. So what are the conditions for a metals boom to occur? We have the periods. So if I identified 4 key indicators for the metal boom to occur. So let's see. The first is the unemployment rate. So if we look back, and this chart only went back to 1940, but if we think of the periods that I mentioned, the first started in 1934. What was the unemployment rate a few years prior? Was there a peak low in unemployment? So we can see here, we'll just look at the civilian unemployment rate. 1921, it's about 11%. Before the boom in the metals, it reached a low of about 3%. And this is an indicator of either GDP growth, as in this case, or in later cases is the excessive printing of money, which we'll look at. So we did see that there's been a low unemployment, 3%. The next we'll look at is the period in the 70s. So remember to let the boom after the 30s started in 1970. So we see a few years prior, we have a 3% unemployment rate. You can see it went down, decreased from the highs to the lows. And this was a sign of printing of money. The next boom that occurred was started in 2001. So we'll go a few years prior. You see here, 1999, 2000, you have an unemployment rate of 3.9%. You see it was a high, 1982, decreased, went up, decreased. In the current conditions, you have an unemployment rate of 3.7%. So this is one of the conditions that I found present in the prior metals boom. So we'll take note of this. The money supply, the unemployment rate, which is correlated to the money supply in these latter cases, because with the QE, that actually decreased unemployment, which started late 2009. The Fed pretty much injected money, and injection of money or the unemployment rate is a temporary solution because you run into problems of inflation and hyperinflation once you start injecting the economy with this excess of money. The next element we'll look at are the Dow. What is the Dow? How's the Dow performed before these periods? So we'll remove the inflation adjusted. And as I mentioned, first period, 1999. 1934, 1935. So we'll look at years before, 1929. You see there's a peak in the Dow. Okay, so before the booms, I found there to be peaks in the Dow. So we'll go to 1970. You can see here, around 1969, there was a peak, and it was a new high that was set, and it didn't go any higher. We have 2001. So we have 1999. There was a peak. You see a long rise. Then it was a plateau peak. Here was a plateau. And right now, you have a peak as well. So that's indicator number 2. The Dow's at an all-time high. The next thing we'll look at are platinum and palladium. Now, platinum and palladium are thinly traded in comparison to gold, and they have real utility in terms of industrial purposes. So it's hard to manipulate the prices as is done with gold and silver. So we'll look at palladium, and we'll look at we can start with platinum. Palladium doesn't go back to 1970, but you can see here. Palladium or platinum bottomed out 2000, started its move. Now in this case it was a little late as compared to gold, but we'll look at other cases with palladium. Palladium, you see there's a move 1996. So the move in gold occurred 2001. Platinum, or palladium rather, moved in 1996, went from 120 to 1,000. So this is an inflationary indicator. You can see the palladium moving. And if we look at the current times, you see palladium was 482, about 500, 2016. A few years later, 2019, it's reached almost 1,800, 17. The current day price is 1744. So platinum and palladium move before gold and silver. And another indicator, and this is one of my favorites, this is a clear indicator here, because the periods that I mentioned were 1935, 1971, where gold started to move, 2001, and current time. So we'll look at the Dow to gold ratio, and this is just the price of the Dow divided by 1 ounce of gold, which many people call real true money. You can see this peaked out before gold started its increase, 1929. This peaked out in 1966, reached the peak. And this peaked 1999, all years prior to gold moving. And this possibly could have been a peak. I'm not sure if this is the peak or if it'll go down and peak again. But even if this wasn't the peak, usually the next peak is reached within 2 years. So this peak was September 2019. So we have 1 year left. But, it is an indicator to buy gold now, because even if this peaks again, reaches 25 to 30, eventually it's going to go down, the Dow gold ratio, and you don't want to risk or make a unwise decision by timing the market and trying to reach that point of perfection or inflection when you can actually purchase at this price. So this indicator is clear as day to me. You see the 3 camel humps, well actually 4 in the current, and all of these humps or peaks they all coincided with an increase in gold. So those are the 4 signals or the 4 elements that I mentioned that cause, and it may be others, that cause an increase or boom to occur, as I related it with chemistry. Before a boom occurs with many elements, you need certain conditions, or with many compounds rather, you need certain conditions, you need certain elements to be present. Once those things are present, all hell breaks loose. You get catastrophic events, and you get rocket prices of gold, of commodities. And I mentioned the unemployment rate that's coincided with the money supply. The Dow's at a high. Platinum and palladium, they're precursors. They've moved before gold, silver, and the Dow gold ratio, as I just showed you. In addition to that, you have other catalysts that may cause a quick decision or quick increase in the price. You have the election coming in 2020. You have a potential Trump impeachment. You have China trade wars, and also you have actual wars that may come into play with Iran. So you can pretty much pick your poison with those additional catalysts. If you look at my other videos, you can see I've been a big fan, big proponent of gold since it was 1,200, and right now it's 1,500. Give or take, which is about a 25% increase. Silver has moved up about 25% as well since my earlier videos where it was $14. And if you look at gold, gold moves typically maybe 25 in times of booms, 25, 30%, 40%, 35%, right around there. So if we have this, we finish a year with maybe 30%. Next year, we get another 35%. Over time, those 30s, 35s, they're going to add up. They're going to add massive value to the price of gold. And I think with the normal economy, all hell is going to break loose once this unemployment rate, and I'll just get back to the unemployment, once this unemployment rate shoots back up. And you can see the steep curve here in the unemployment rate, how fast it increased. And this was tied to foreclosures, businesses collapsing, a big decrease in the Dow, everything. Well, the unemployment was a result of the decrease, but you see 5% April 2008, and by October 2009, 10%. So I suspect this next increase in unemployment will be even greater, because this is a true inflationary unemployment rate. And most of the growth has been fictitious, and it's been all driven by increase in the money supply, which I mentioned is a temporary fix. And similar conditions happened in 1920 with Weimar Republic, which was Germany. You saw unemployment decrease temporarily. Factories, they were busy producing products, and that was a temporary situation. So let me know your comments. What do you think below? What price do you think gold will go to? Do you think this analysis was sound analysis? Thanks for watching. To subscribe for more financial content, please click the circular button where the red arrow is located, and also watch one of the top 2 videos up top.